Hello, I'm Paul Kangas, back on Wall Street at the New York Stock Exchange. As I noted in our first video, How Wall Street Works, this and other stock markets are the key to our system of capital formation, which enables corporations to raise the capital they need for expansion. But if you're like most investors, you're probably more interested in stocks as a means to accumulate capital for yourself. And in this program, we'll look at some of the leading strategies that Wall Street's professionals use with varying degrees of success to turn the stock market into their personal money machine.
This is a special edition of the Nightly Business Report, the NBR Guide to Stock Market Strategies, featuring Paul Kangas and the NBR team, and produced in association with Reuters, the world's largest electronic publisher. Here's your host, Paul Kangas.
Now, many beginning investors are under the impression that to make money in the stock market, all you have to do is buy a stock, hold it for a little while, and then sell it for a big profit. Well, sometimes that simple buy and hold strategy does work. But if you buy at the wrong time, buy and hold can result in losses rather than riches. In fact, many professional traders say the difference between success and failure can be summed up in one word: timing. And to reduce their risks, they have developed an approach called market timing, which focuses on identifying the right moments to be in and out of the market. New York Bureau Chief Scott Gervey has more.
The art of market timing sounds like some sort of voodoo investing to many. The buy and sell signals of timing gurus are taken as signs from an oracle on high. It is all quite simple, really. The market goes up, the market goes down. Profits can be made if you buy at the trough and sell at the peak of each cycle.
This kind of strategic switching over a period of 21 years produced 10 times the profits of simply buying and holding the stocks.
It's the quantification of the old adage, buy low and sell high. Or, to use another cliche, don't fight the tape. That's Wall Street jargon meaning don't fight the general market trend. But how do market timers sense when the market trend is about to change direction? Different market timers use different indicators, and it is the quantitative inputs to the individual market timer's formula that give each a distinct forecast. Most experts believe interest rates are one of the key factors in setting the market's tone. Market timer Martin Zweig says that is the basis of his rule, don't fight the Fed, that is, the Federal Reserve Board.
I've studied this for 31 years, and we've done a lot of work here. We've developed computer models. And what we found is that the most important condition would be monetary. It's not the only thing that matters, but it matters more than the rest. And it matters more than the rest simply because we found that that's the case by our testing. By monetary conditions, I mean Federal Reserve policy, the trend in interest rates, loan demand, money supply, and that type of thing. And that gets roughly half the weight in our indicators.
One problem with applying market timing methods to the small portfolio is the cost of each transaction. Too many buy and sell signals can really eat into returns because of the cost of sales commissions and taxes. And the need to act quickly may also make it difficult for the individual investor to use market timing correctly.
My sense is that most individuals are so emotionally involved in their investment that they will not follow the disciplines. And the other question is, can you improve returns if you use timing? Well, it isn't just improving returns. It is that while you just mentioned the long term, what happens if that long-term investor all of a sudden needs the money and it's October 19th, 1987? Well, the buy and hold discipline will never, ever protect you against major market losses. And that is when you might need your money.
To overcome some of these drawbacks, some market timers have turned to strategies that use mutual funds. These are called telephone switch methods. They typically involve moving money between funds in a single fund family.
The mutual funds provide the convenience and, for the average person, reduce the cost of timing significantly. And I think that tracking the mutual funds is advantageous because, as opposed to the individual stocks, the mutual funds will have lower volatility since they are averaging a portfolio of stocks.
There are a few inputs to the timing formulas that most analysts leave out, but there are those who insist the movement of the Earth, stars, and moon exerts a powerful pull on Wall Street.
I calculated the entire cycle, say for instance, the conjunction or same space with Mars and Jupiter, then 30 degrees away when Mars moves 30 degrees away from Jupiter, and then 60 and then 90, all the way around the cycle. I calculated the whole cycle, and then I add up a number of these cycles, and when a number of them are pointing in the same direction, the statistics are spectacular.
You do not have to believe in the planetary cycle to have success in the market. Market timers say all you need is the discipline to watch for the signs and follow the rules. Scott Gervais, NBR, New York.
There's one factor you should keep in mind: taxes. Mark Hulbert of the Hulbert Financial Digest studied the performance of many market timing newsletters over a 5-year period, and he found that the resulting gains of individual investors were virtually wiped out when it came time to pay the tax bill.
And over the last 5 years, of the 29 market timing strategies I am following, either 1 or 3, depending on the assumptions used to calculate the taxes, beat the market, which is basically to say that the odds of beating the market with taxes by following a market timer are very low.
Well, I suppose that a bigger tax bite from market timing is to be expected, if only because you have to pay taxes on each profitable trade. So does it follow that the more times you go in and out of the market, the higher taxes will be? Is that what you're saying?
That's absolutely right. The only exception to the rule, as you just stated it, is if your market timer is losing a lot of money, and in that event, actually a greater number of switches helps you because you'll have that many more tax losses to offset the rest of your income. That's sort of an exception that doesn't help you because obviously you want a market timer that's going to help you. If your market timer is profitable, the more time he switches, other things being equal, he's going to have you pay more taxes.
For this reason, Hulbert says market timing techniques are best used in tax-deferred accounts like IRAs and KEOs, where the tax bite is minimized. Now, as NBR's resident market expert, I'm often asked what's going to happen to stock prices. My standard answer is they'll definitely fluctuate. And given the stock market's frequent volatility, that's about all anyone can say about prices with any certainty. But what if it were possible to use the lessons of the past to predict the direction of the market or of individual stocks? That's essentially the strategy used by practitioners of technical analysis, known as technicians or chartists. Despite the uneven zigzags and gyrations of stock prices over the course of a day, technicians contend that prices ultimately rise and fall in recurring patterns. They say that's because the market is not moving at random, but is responding to the constant tug-of-war between sellers and buyers, or supply and demand forces. And they contend the best way to figure out where these forces are pushing the market is by studying charts, which are basically pictures of past stock price movements. The idea is to find what's known as a trend reversal, signaling that an individual stock, or the market as a whole, is about to break out of its long-time trading range and move into a new price level.
I think investor psychology is probably 80+% of market moves, much more important than any specific news event. And I really think what you're doing when you look at charts, and this is why charts work, it's kind of like a cardiogram. Like a doctor could look at a cardiogram without ever meeting us, and he could say healthy or unhealthy. We're looking at the cardiogram of stocks and seeing the psychology that's involved in there, and is it a healthy buying and selling equation or an unhealthy equation? It really isn't, such a mystical thing.
Weinstein and other technicians say the signal to watch for is whether the stock breaks through its support level, that's on the downside, or its resistance level on the upside.
Let's say your stock XYZ falls from 40 down to 20, and then a couple of times, it may not be perfectly at 20, but one time it holds at 20, it bounces. The next time it holds at 20 and a half, you start to see approximately 20 is a support area, and there are buyers who at that point think, this stock is cheap, I want to buy it. Conversely, every time it gets maybe to 24, 25, there are people saying, gee, just let me get out of this, even with a small loss, and it gets knocked down again. So a very definable trading range forms on the chart.
So how can the investor tell whether a price move out of the trading channel is just a false start or the start of a major new trend? The tool used by nearly all chartists for this purpose is the moving average, a line that clearly indicates the major price pattern over a particular time period.
If you look at a chart, the untrained eye will see all kinds of wiggles and gyrations. Where's the trend? Where's the market really going? The moving average does nothing more than smooth out that trend. So instead of something like this, you get a smoother curve. Here's what you can do with it, and what's done by the most professional traders. As soon as the stock breaks below, the stock price breaks below that moving average, it's your signal to get out. As soon as the stock breaks out of a downtrend and starts turning up, it's your signal to get in.
Still, many technicians look for the confirmation of a breakout through another signal. In many cases, that is the volume of stock trading that accompanies the price move.
Volume is really sort of like the fuel for a stock's move. If you have two charts that are equally bullish and they both break out of a base, but one has sort of tepid volume, it might go up, but it doesn't have that old tiger in the tank. Whereas if you have somebody else where it's traded 10,000 shares a day on average and suddenly trades 150, 200,000 shares, that shows that real buying is coming into a stock and it's excited demand that really moves stocks higher.
On the sell side, there's a somewhat different school of thought. The idea is that if the market is going down, even though very few people are selling and the volume is low, imagine what would happen if a lot of people start selling.
Chartists say certain configurations on a chart can also be of major significance. One of these is known as a head and shoulders pattern, as Stan Weinstein explains.
A head and shoulders is kind of a rare pattern. It doesn't happen as often as people think. But if you do see a head and shoulders, which very simply is the stock has had a big rise and it has the normal correction and the volume is heavy, then you go to a new high, but it comes all the way back down to where the last bottom of support was. That's already unusual. Then you have a third rally that doesn't get as high as the peak at which we call the head, but it gets equal symmetrically to the left side, and the volume is probably the least in that, and then it starts to break below the neckline, which was all of those bottoms of support. Take that seriously. That's not going to lead to a day at the beach.
Another is the double top or double bottom, described by Martin Weiss.
The market goes up, goes down. The next time it goes up, it should go even higher, right? But if it fails to do that, and it just matches the previous peak and then starts moving down, it's your first signal that there may be a turn. But it's not a real signal until it moves down below the previous bottom.
But chart moves are often fuzzy and subject to interpretation. For this reason, even many technical analysts caution against relying solely on charts in making decisions. Technical analysis isn't the only strategy that looks backward to where stock prices have gone in the past as a clue to their future course. There is also historical analysis, which looks to establish trends in stock market activity that coincide with certain recurring events. And here to discuss the use of historical analysis as a market strategy is our good friend Bill LaFave, Senior Vice President for Market Strategy at Tucker Anthony Sutro. Bill, welcome.
Good to be back again.
Is it true that history has a way of repeating itself as far as stock market moves are concerned?
Yes, you might say that the stock market tends to live in excess. In other words, moves tend to go too far one way or too far the other. And successful traders sense when we've gotten too far one way or the other, and either sell them short or go long.
Almost as predictable as a pendulum on a clock.
Very much, very similar to that. Yeah.
One of the most frequently used recurring events tracked by market watchers is the presidential election cycle. Are there some general rules about how the market performs in election years and succeeding years?
Well, there is a quadrennial cycle. This is the 4 years. And generally, now this is not always the case, but generally there's a period of euphoria immediately following the election, no matter who wins. There's a bubbles up. Then there comes a point toward the middle of the 4-year term where the party in the White House decides we better start getting ready to get reelected. And so they start doing things, whether it's raising interest rates or whatever. They're trying to get their ducks in a row. And generally, that makes the market come down. It can come down for maybe a year. So in other words, we're getting to a point now where about a year and a half into the 4-year cycle. Then, if they've done everything right, it starts up again. It goes for 2.5 years, and it rises usually to a new all-time high.
When have they ever done everything right?
Well, that's why I hedge it. If.
Exactly. You know, Jim Stack, who writes the Investec Market Letter, says that based on the 16 elections prior to 1992, stock market highs during the latter half of an election year are far more likely to hit after the election. Do you think there's a reason for that?
I think the reason is that all the way up to the election, you've got a certain amount of indecision. What's liable to happen? Mm-hmm. But the election coming as late as it does, with about 2 months left in the year, then all of the doubt has been resolved, and now they get ready, and usually they tend to buy, and usually you tend to get a new high, a higher high after the election.
You, of course, are sometimes, and I think generally referred to as the unofficial keeper of the Dow average. That is the Dow Jones Industrial Average. Now, because of the comprehensive records that you keep on it, have you found any trends in the Dow 30 over the years?
Well, I have this one thing that seems to repeat, not every year, but you know, each year we rank the stocks from the best to the worst. In fact, the December quarterly roundup here on Nightly Business, we give you the best and the worst.
At the end of every year, you're here to give us the first with the facts.
Well, you know, there's an interesting parallel here. Every once in a while, it happens often enough to consider it, that this year's, we'll say, lowest rated stock, biggest percentage decline, becomes next year's #1 star performer.
In the Dow 30.
Yeah, now just in the past few years, it's happened. For instance, in 1991, Goodyear Tire was up 183% on the year. That was #1. But the year before, it was the worst, down 56%. Now you go back to 87, Bethlehem Steel was the best, up 162% that year. The year before it was the worst, down 59%. And then in 85, Union Carbide was the best performer, up 93%, and the year before it had been down 41. So they went from the outhouse to the penthouse.
Interesting way to put it. Finally, is there any way that the individual can use this kind of historical information in his or her own trading?
Well, a variation on just the last of the first that I was outlining a moment ago, a variation is that very frequently this year's stock that's out of favor becomes one of next year's favorites. So in other words, you look at the bottom 3 that we give you here on the show, or maybe the bottom 5. Out of those 3 or 4 or 5 worst stocks, you'll find the stock that's going to perform the following year.
So we should look very closely at the end of the year report to see which were the worst performers in the Dow 30.
We'll tell you the worst ones. What we don't know is which one's going to be the best one the next year.
Thank you, Bill. My guest, Bill Lefebvre, Senior Vice President for Market Strategy, Tucker Anthony Sutro.
Paul, it's always a pleasure to be here.
After all this talk about basing stock purchases on timing, charts, or historical patterns, you may be saying to yourself, whatever happened to simply buying the stocks of companies that are good values? Well, that's an approach called value investing, and it's been around for at least 60 years when it was first made popular by 2 men, one named Graham and the other Dodd. But it's made money for a lot of investors, and as writer-correspondent John Defterios reports from Los Angeles, it's a method that still claims many devoted followers.
If there is a true follower of the Graham and Dodd school of value investing, it is James Buchanan Rea. Rea met Benjamin Graham in 1974, and they became close friends. 2 years later, they launched the Rea-Graham Mutual Fund.
We both admitted making money was our aim in a good, legitimate, conservative way without taking high risks.
Graham first outlined value investing along with David Dodd in Security Analysis, a book they released in 1934 after the Great Depression. 40 years later, Graham and Rea boiled down that broad strategy to 10 criteria for bargain investing. 5 of those dealt with buy levels and 5 with financial soundness. On the buy level side, they look for stocks that possess some of the following: an earnings ratio at least double the AAA bond yield, the price to earnings ratio down 4/10 of the previous high, the stock price to be equal to or less than 2/3 of the tangible book value, a dividend yield to be equal to or greater than 2/3 of the AAA bond yield, and they want the stock price down to a company's net current asset value. On the financial soundness side, the keys are low debt and a decade of strong earnings growth.
E is 6.7.
Rea and his son Jim Jr. stick to those disciplines in their fund, even if it means lowering stock holdings to 25% of their portfolio.
We're buying companies when they're out of favor, when people don't want them, and the stock price is greatly depressed compared to the earnings or the dividends or the book values or one of the other factors that we're looking for.
Perhaps the best-known believer in value investing is billionaire Warren Buffett, who was once a student of Benjamin Graham's. In addition to looking for value, Buffett stays away from sectors he doesn't understand, like biotechnology and high technology. Instead, he hunts down undervalued brand names. In early 1992, it was razor maker Gillette.
I can understand Gillette. I mean, it's not too hard to think about every night when you go to bed thinking about a couple billion men going to sleep with hair growing on their face. And that's my kind of business.
When following Graham and Dodd principles by the book, the Rays say the idea is to invest in a company, not speculate in a stock. Private fund manager Alan Rudnick says his philosophy of looking for companies with a record of rising dividends follows many, but not all, of Graham's principles.
We are definitely an offshoot of the Graham and Dodd school.
At Rudnick's firm, Kane Anderson, more emphasis is placed on an upward earnings trend. Anheuser-Busch is one of 35 companies that passed the firm's test in 1992.
We basically have blinders on, where 97% of publicly traded companies are absolutely of no interest to us. They don't pass our screens.
With more efficient markets today, Graham and Dodd followers say it is harder to find values. But as Graham spelled out nearly 60 years ago, with patience and cash on hand, one can be ready to act when the opportunity presents itself. John Defterius of Reuters for NBR, Los Angeles.
Now, identifying an undervalued stock is faster said than done. But consider this. Who should be in the best position to judge whether Wall Street hasn't yet recognized a stock's potential? How about the officers of the company themselves, the so-called corporate insiders? To get onto this inside track, some investors follow whether corporate insiders are buying or selling their company's stocks. One who compiles this information is Norman Fosback, who edits a newsletter called The Insiders.
Insiders file a report known as a Form 4 for every trade they make in their company's stocks. And that report goes to Washington, D.C., to the Securities and Exchange Commission, and they're on the public record. We have found that when most insiders that are reporting trades are on the buy side, that the market is probably very close to a turning point in an upward direction. And similarly, when insiders are selling heavily, the market is far more likely to go down than up. We cannot know what the insiders know when they are making their buy and sell decisions, but we can do what they do because they have to file reports of their trades.
Despite many insider trading scandals over the years, Fosback notes that trading by corporate insiders is usually completely above board. So long as they report their trades to the SEC, he says corporate insiders are only banned from trading based on information that has not been released to the public. Now, what if being on the inside track just doesn't fit your personal geography? Well, if you're a person who likes being on the outside, there's a market strategy that's tailor-made for you. It's called the Contrarian approach. And as Karen Ryan reports, it involves going in the opposite direction of Wall Street's prevailing winds.
While most Wall Street traders work in close proximity to New York's financial district, Bob Drach has made a career of not following the crowd. He watches the market from 1,300 miles away in South Florida. But what makes Drach different isn't just where he works, it's how he thinks. Drach publishes a market newsletter that expounds the Contrarian philosophy, a philosophy that believes the best way to win in the market is to do the opposite of what most market watchers expect, the so-called consensus view.
It's not because the majority are stupid, most of the time. It's because there are things involved in the market beyond just fundamentals. There are structural factors and psychological factors. And the crowd just overprices and underprices just because of the momentum and the media reinforcement.
To take the contrarian view, it's first necessary to find out what the prevailing sentiment is. Drach says he looks at whether investors are raising cash through indicators such as the net sales of equity mutual funds or cash reserves of institutions. But he also looks at a weekly column in Barron's called Investor Sentiment Readings. It quantifies the opinions of investment advisors and newsletter writers by showing what proportion are either bullish or bearish on the market outlook.
Advisory sentiment is an excellent contrary indicator. The experts may be right during primary market trends, but when they are all bullish, it's usually the top of the market and ready to get, and you should be prepared to get out. Similarly, when all of the advisors are bearish, you should think about getting into the market.
When contrarians are convinced the market is overpriced, they will often bet against the crowd by shorting stocks. One who's found that to be very profitable is Michael Murphy, who runs the Overpriced Stock Service.
The consensus poll bids stock prices to their point of view. Sometimes they are right, but when they're wrong, of course, they're often very, very wrong, and stocks are either too depressed and shoot up or way overvalued and drop sharply. And to us, the big money is made in catching those big moves.
Shorting a stock involves borrowing a stock from a broker and then buying it back later at a lower price.
Your broker will go out and actually sell the stock before you own it. Then you wait, and if the stock drops, you tell them to buy to cover. The broker will buy it back in, and your profit is the difference between where you sold it and where you bought it.
But there is some potential danger for the short seller. If things don't go as expected and the price of the stock goes up rather than down, then brokers require short sellers to cover themselves. That means either coming up with more cash or buying the stock back at a higher price. In that case, potential losses are unlimited. Bob Drach says the contrarian method is not well suited for investors with only limited amounts of money, since they can't diversify their portfolios enough to protect against losses. But for those who don't mind forgoing Wall Street for the less traveled road, contrarianism has its advantages.
I would say that some people would think I'm somewhat eccentric, yeah. But, you know, it's not a stressful eccentricity, that's for sure.
While Bob Drach follows the market from his lair on Key Biscayne, one of the main hangouts of professional stock traders is also located far from Wall Street. It's the Windy City, Chicago, the capital of options and futures trading. And as Leslie Nickel reports, options and futures are often used by investors who want to play stocks, but with more bang for their buck.
This is the Chicago Board Options Exchange, a place where the uninitiated could easily feel disoriented. Traders here talk in terms of covered calls and vertical spreads, straddles, in the money and out of the money. But once understood, options can be used by both conservative investors and speculators to enhance their stock market returns.
You can select to tailor your risk, to tailor your exposure to the market, or to generate some expected return.
While options generally cost a fraction of their underlying stocks, the options buyer stands the risk of losing every dollar that he or she brings into the market. That aside, experts say it is possible to pursue a conservative strategy by combining stock holdings with listed options on the same stocks. With the right combinations, the investor can not only maximize profit potential, but also hedge against market declines.
The kind of phrase I think the regulators don't like to hear of everybody can win can apply in options trading if it's practiced in a conservative way.
And about the most conservative way to use options is to write a covered call. This simply means that the investor buys stock and writes a call option against that stock. Here's the way it works. If you buy 100 shares of a stock at $50 a share and sell a call option against that 100 shares, you receive a premium income, an amount paid to you for selling that call option. This premium gives you an immediate cushion against a decline in the stock price. But if the stock price goes up, say to $55 a share, and your call option is exercised, and your 100 shares is called away from you, you sacrifice the upside potential, but you still have received that premium income. So that stock you bought at $50, if you received a $5 premium for the option purchased, means you have in effect made $5 a share. Buying a married put is another conservative strategy. This is primarily for investors who want to buy a particular stock but are afraid that the overall market is too high and may fall back. The investor buys the stock and then buys a put against it. In this way, the investor's downside risk is limited to the cost of the put. However, if the stock rises, then the investor loses the price of the put option. But unlike the covered call, under this scenario, the investor retains unlimited upside potential.
Buying options only, of course, involves the risk of exposing yourself to the loss of the price paid for the option. Okay? Now that loss may be a lot smaller than the stock price taking a substantial price decline. So, you know, it's a funny way to look at a small loss being a good thing.
Traders call the straddle the third of their top 3 favorite option strategies. This is for the investor who expects a big stock price move but is not sure which way it is going to go. In a straddle, the investor hedges his position by buying a call and a put on a stock at the same time. This way, one of the options should end up with a profit, more than offsetting the loss from the other. However, if the market does not move, the investor loses both premiums. Some speculators take a different approach, one that is considered very risky. They simply sell calls without holding the underlying stock, something called a naked option. People do this if they expect the stock price to move lower or stay the same. If they're right, they get to keep the entire premium. If they are wrong, they may end up with a 100% loss.
Uncovered or naked call option transactions are considered extremely high risk, rather dangerous, are typically only practiced by the most well-heeled investors and sophisticated traders. In effect, people who've got money to lose.
In addition to buying puts and calls on individual stocks, the investor can also use options to play the direction of the market as a whole. Options indexes, such as the OEX, mirror the movement of the Standard & Poor's 100, while others track other broadly based market indexes.
And if used correctly, analysts say they can give the small investor the leverage previously available only to managers of giant stock portfolios. Leslie Nichol, NBR, Chicago.
Joining me now is Bernard Schaeffer, Executive Director of the Investment Research Institute based in Cincinnati. And Bernie, your newsletter, The Option Advisor, looks at individual stocks but plays them through the use of puts and calls. Why not just buy or sell the stock involved, just the stock, the underlying securities themselves? Why deal in options?
Well, there are a number of advantages, particularly for the smaller investor. I think these days the smaller investor has pretty much gone to mutual funds for his stock-type trading. But if you're looking at individual stock names and you don't have $50,000 or $100,000 to invest in each stock, but maybe $10,000 or $20,000 to speculate with, options give you an ideal way to be able to diversify in a number of stocks, both on the long side and potentially on the short side, and do it for a very reasonable amount of initial investment.
What roughly is the percentage you pay for a premium on, let's say, a call option where you plan on seeing the stock, or you want to see the stock go higher? Or a put option for that matter. Is there a similarity in the percentage you pay for premiums?
A lot of it, of course, depends on the amount of time that you're buying, so to speak. Some of it also depends on what's known as the striking price of the option, which relates to
how close it is to the real price.
How close it is to the actual price of the stock. But if you're talking about an option that, let's say, has about 6 months to run until expiration, and the striking price is pretty close to the current price of the stock, you might be paying in the area of 8 to 10% of the stock price for that 6-month option. And maybe for a 3-month option, you might be paying 6 or 7% of the price of the stock.
How do you anticipate a future breakout in price, up or down? How can you tell that a stock is ripe for that kind of move? Or can you?
It's difficult. It's different from what people do when they're trying to pick a good stock. A lot of people are very fundamentally oriented when they're buying stocks. They're relying on earnings projections and the outlook for the company. When you're setting a time frame, which by definition you are when you're trading options, you have to be much more sensitive to what the past price movements in that stock have been and what the future price movements are going to be.
Let's say for every $100,000 of money you had to invest, what percentage would you advise to be playing in options with?
If you have $100,000, let's say you would devote normally to stocks or mutual funds, I would say $10,000 should be the capital that you have potentially devoted to options. I don't think you should always be playing with the full $10,000 at any given point in time. And the most important thing is options are cheap, diversify, and don't always be on one side of the market. Don't let yourself be in a situation where if the market goes down and all you have are calls, there's no way you're going to make money because the market is just going to take everything with it.
Thank you, Bernie Schaeffer of the Options Advisor newsletter.
My pleasure, Paul.
By this point, you know something about market timing, technical analysis, historical analysis, value investing, insider tracking, the Contrarian school, and how to play stock options and futures. But with this full plate, perhaps you're still undecided as to which of these strategies is best for you or your portfolio. So we thought it would be helpful to get the views of some dispassionate observers who have studied many of the methods we've discussed in this program. We brought together the noted authors John Rothchild, Adam Smith, and John Train. And based on their research, we asked them which stock market strategy they think is best for the small investor.
I think what works best for a small investor who is willing to do his own work is to follow not only my idea but Peter Lynch's, and that is to look into the things that you know best. From your own business, from your own family, from your own relatives. You might remember that Peter Lynch's wife picked up a legs package at a supermarket and said, what company does this? These are terrific, and so on. But you have to do a little bit of arithmetic homework. The advantage that small investors have is that there are 25,000 public companies, maybe more, and the analysts are all bunched up in the top 200 or 300 where they can do, where their firms can do the brokerage business and where their firms can, more importantly, do the M&A work, the corporate financing and the mergers and acquisitions. So you got to hit them where they ain't, and if you stay out of the way of the crowd, you have an opportunity to do some, get some real gains. That doesn't mean that you can't make good money in blue chips that the Coca-Colas, the Mercks, and so on have done well for 10 years, and there are going to be others in the next 10 years. But what has always appealed to me is finding your own little treasure.
All right, John Rothchild here in Miami. Which of these strategies makes the most sense for the small investor in your opinion, and why?
Well, since I'm the fool in his money, I think the best strategy is probably do whatever I'm not doing at the time. But I think, speaking for the average investor, if I can, I think I'm as close to that as anyone on this panel. Mm-hmm. What happens is we know how to lose weight. All you have to do is not eat. But then we buy fancy diet books and we try other things, and some of us don't lose much weight. I think with stocks, we know what to do. If we're not capable of picking companies, or if we don't follow companies, as Jerry said, then we ought to be in some mutual funds, some good mutual funds, and we ought to hold them for the long term. Mm-hmm. The trouble is, it's not so easy to do.
Takes discipline.
Takes discipline, and it takes blocking out a lot of the other messages that we hear all the time.
All right, John Train, your opinion. Which strategy is the best for the small investor, and why?
One that hasn't been mentioned, specialty growth stocks. Obviously, if you can identify consumer products that are around you, you may have an advantage if other people aren't using the same consumer products. The specialty growth stock does take study, but if you can get it more or less right, you will again have fewer competitors, and with any luck, you can hold on to it for long periods of time. The lethal penalty for the small investor is high turnover, whether because they get into a broker-dominated investing situation or because they get into trading derivatives, such as commodities and futures and so forth, which will kill them off in no time.
The long-term message is an important one. I don't know how, there are some small investors, I suppose, who can trade or move quickly and efficiently, but again, people who invest for the long term do have an advantage, both in the costs and in the kind of horizon that they're able to maintain for themselves, which differ from the pressures that are on professional investors.
All right, interesting. Now, Adam Smith, from your book, The Money Game, I take it that you are somewhat skeptical that technical analysis or charting can predict the future courses of stock prices. Is that right?
Paul, I don't think anything can predict the future course of stock prices. If anything were able to predict the future course of stock prices, the people who have that technique would use it, other people would find out about it, and the stocks would quickly move to that point that the analysis dictates it should. So I am skeptical. I think it's like map reading or compass reading or anything else. Any kind of tool that you can use is a help in helping you make up your mind. The man who taught me about the stock market used to say of technical analysis that it was like having a good bird dog when you went hunting, but that didn't mean you gave the gun to the dog.
I'd like to say just a word, if I may, on the technical analysis question. I think you have to divide it in two. The diamonds and pennants and rounding bottoms and double tops and all that is, I think, absolutely known not to work. I've studied it to death. Market analysis, as distinct from technical analysis, can be helpful. For example, it is simply a fact that when a great many stocks are selling for less than net quick assets, in other words, below working capital, or when the market is at a very high multiple of book value, or other familiar indications of where you are on the pendulum, that can be illuminating.
John Rothchild, your latest book is about the legendary portfolio manager Peter Lynch, who formerly ran the Fidelity Magellan Fund. Lynch was probably the most successful practitioner of growth investing, the same method which John Train recommended earlier. But has the time to invest in growth stocks come and gone?
Peter specializes in making money in all kinds of stocks. He's done well with cyclicals, and he especially does well in going into parts of the market where the other experts aren't treading. Basically what Adam Smith said about the small investor, Peter has also tried to do. Find the ones that aren't being followed, find the ones that are undervalued. But as for the growth, what he likes to do is find small retail or restaurant operations that are beginning in one part of the country and that gradually expand. And his point is you don't have to get in day one. You didn't have to start with Walmart the minute Sam Walton opened the first store. You can wait 5 years, 6 years, 7 years for the concept to prove itself. And then as it moves across the country, you've got another 10 years, maybe more, of good growth. So that's basically been his, those are his favorite stocks.
Okay.
Paul, could I mention one other thing?
Certainly.
It's an aphorism that Warren Buffett had, or at least an observation, that they could close the New York Stock Exchange for 2 years and he wouldn't care. And his reasoning behind it is that when he picked a stock, he treated it like buying a part of a business. And if you buy a part of a business, the fact that somebody gives you a quotation on it one day and another quotation the next day, another quotation the day after, doesn't matter as long as the business is performing. And that was his criterion. He said the stock exchange is closed on Saturday and Sunday, and he didn't break out in hives. So the benchmark became, what is it that you're comfortable with? If the market marks your stock down 20%, do you say, oh boy, now I get to buy more, or do you toss and turn and grope for the bathroom light?
I think that's without doubt the greatest single truth that the small investor should absorb.
Thank you, John.
A share of stock is a share in a business. You're a partner, and you should understand the whole business and be comfortable with it at that price, just like buying a house.
No matter which stock market strategy you choose to employ, keep in mind that no strategy is foolproof. Even when the signals seem to be pointing straight in one direction, the market can, and often does, go in the other. So the smartest investors are those who don't put all of their eggs in any one basket. In fact, the experts say everyone in the market should maintain a safety cushion of liquid assets at all times. And one final piece of advice. To see just how your strategy is holding up, be sure to watch the nightly business report. I'm Paul Kangas, wishing you the best of goodbyes.
If you'd like to learn more about personal finance or investing, the NBR Video Library of Personal Finance has the information you need. A good place to begin is with 3 award-winning videos: How Wall Street Works, the NBR Guide to Buying Insurance, and the NBR Guide to Retirement Planning. To order the set, send $59.95 plus $4 for shipping to NBR Videos, Post Office Box 2, Miami, Florida, 33261 0002. To order by credit card, call 1-800-535-5864. Individual tapes are also available.